So here is the result. And to calculate the portfolio return, we just the first way we take the proportions of this multiply with in return plus proportion Google multiply with the return here and sample. Then we can use average this. So it's the same, and the portfolio variance induced by or we can use normal way by these equations. To multiply plus the variance plus power to by variance plus to multiply covariance. Power to covariance. Yes. The return standard deviations is square root of variance we can use the function standard deviations sample. So it's the same result. And because the proportions of Apple and Google equal to 0.5 each, one case in the many scenarios that we can build. So I would like to demonstrate it by data table for various scenarios. And firstly, I will put the data of portfolio standard deviation here and portfolio mean return here. And I just choose data analysis data table, and the column is the proportions of Apple. So here we can get the table with the various scenario. And I would like to draw a graph to illustrate this. The x value is standard deviation, and the y is the return. Okay, so here is the opportunity set curve for this portfolio.
So you can see here, when you combine two stops with various weight, you can create a curve, and we call it the efficient frontier. Up two stops, just two stops.
Yes.
And in the next chapter, we will figure out the efficient frontier of the maybe many stops, and maybe all with the whole market. Okay, but the principle, the basic principle, you need to know that you change the proportion, you change the weight of the stock in your portfolio, and it's created many possibility that you can change the weight of each stock in your portfolio, and this will draw the curve. We call the curve is the efficient frontier that we will study in the next chapter. Okay.
Yes. And the next one and the last one is the portfolio of four stock. Because in the first part, King Lộc had presented to you how to calculate the variance and covariance very carefully, and after the summary teacher summary, I think that you can understand deeply about this. So I just that covariance, variance and covariance and mean returns is valuable information. And I have two portfolios with the different proportions of four stock here, A, B, C, and D. And remember that the sum of these proportions for each portfolio have equal to 1, which means 100%. And to calculate the mean variance and covariance relations portfolio X and Y, with the simple way we can take the equations with each proportion multiply with each return. Here is the result, but if you have a lot of assets, you cannot do by this. So I would like to apply the function here's matrix multiplying to calculate mean more for more quickly. X so we have the same result, but it's more efficient. And for the variance, we also have the normal way to calculate, but I would like to apply these functions. X transpose of X. So we have do similar with portfolio E. Transpose Y. For the covariance, we just apply the function in Excel. X transpose Y. And for the correlations, we just take the covariance divided by products of two standard deviations, square root. Covariance X multiply square root of variance E. So here This is just the simple portfolio, and the next is the combinations of two simple portfolio, which the proportions of portfolio X is 0.3 and proportions of portfolio Y is equal 0.7, and to calculate the mean intercept, the proportion multiplied with the mean plus proportion multiplied with mean, and do similar with the variance to multiply with um, variance plus multiply plus to multiply with variance and it's just square root of. So similar with the portfolio of two stock, I would like to create more scenario. The input value standard deviation, mean, just the data product analysis data table. We just take the proportion X. Okay, so here is the various scenario. For example, of stock A, B, C, D. So about we also have the mean return as available data. So just copy it. And standard deviation of A is square root of the variance square root of variance B square root C square root of D. So type is to this. Yes. And I will illustrate these into the graph too. X is standard deviation. Y in return. Okay, and add about X. Y. Yeah. Here we have, this is the efficient set of the portfolios. So, and the red point is the value of stock A, B, C, and D. And the last content that I want to talk about is the envelope portfolio. Envelope portfolio is the portfolio of risky assets that give the lowest variance of return of all portfolio having the same expected return. Here is the portfolio have the minimum variance, which the values is 32.84%, and the expected return is 9.97%. An efficient portfolio is the portfolio that gives the highest expected return of all portfolio having the same variance. And with the point above the minimum variance, we can call it efficient frontier. The envelope, if two portfolio on the envelope, then all of the individual stock would fall on or inside the curve. But in our case, we have stock A and D all out the frontier, so X and Y cannot be efficient portfolio in this case. So that's all about the envelope portfolio. I just gave you the overview, the definitions, because in the following sections, the presenter will demonstrate deeply to you through chapter 9. And that is the last content that I want to talk about. And next, Thảo will present to you the last main content, beta calculation, and SML.
Okay, just hold a second here. I want you to distinguish the envelope and the efficient frontier. So you can see the envelope is the curve. On the curve is the envelope, and the efficient frontier is just a part of the curve, starting from the minimum, the global minimum variance portfolio, the GMVP that we just studied in the first presentation. So you can see when you determine the GMVP. That's the portfolio have the global minimum variance or minimum standard deviation. You can draw the efficient frontier, and the efficient frontier is just a part of the envelope. The envelope is on the curve. Do not misunderstanding about the concept. Someone just see the curve is the efficient frontier. No, the curve is not the efficient frontier. The curve is the envelope. The curve is the envelope, and the efficient frontier is composed by the efficient portfolio. So what is the efficient portfolios? The efficient portfolio is the portfolio have the minimum standard deviation or minimum variance, which given the return, or the maximum return, which given the standard deviation. That is the best portfolio you can get. So that's the efficient portfolio. And when you combine those efficient portfolio, you have the efficient frontier. So the efficient frontier starting from the minimum variance portfolio and go up, just go up. So you have the efficient frontier and the envelope. These are two different concepts here. Okay, but I want to ask you a question in this situation. If you have the envelope, the blue dot line is the envelope, and if I just put on money into the stock A, which means I have the 100% proportion on the stock A, and stock B, C, D just 0%. So why my portfolio is not in the cover of envelope, the envelope?
Because with the same standard deviations, if you choose the portfolio included in the curve, the envelope portfolio, your return will be higher.
I know that, but I just told you that if I invest all money into the stock A, so my portfolio is a 4 stock, but the BCD I don't invest. I just put all my money in the stock A. Stock A have a 100% proportion. So which means my portfolio is just the A dot in the graph, and it's outside the envelope. So why is that happen in this case?
You mean that why the stock A is falling out the curve?
Yep. So for example, you have the portfolio N with the weight is 1000. So this portfolio will be inside, would be inside the envelope. The envelope, because the envelope is the limitation, the limit that we, on the possibility we can create, on the possible portfolio we can create, is inside the envelope. So why the stock A is the portfolio N with 100% invest in a stock A, is outside the envelope. Or stop D is just outside the envelope. If I put 100% my money into the stop D in my portfolio, so we just create a portfolio outside the envelope. Why is that happen?
I think when we mention about portfolio, we have to invest into at least two assets. So if you just do one of them, it's no longer portfolio anymore.
Teacher, can I answer for my teammate?
Okay.
So I think that because if you invest only on one stock in the portfolio, we have the if we comprise many stock, that means we have the diversification. That means we can for example, the diversification can reduce the standard deviation. However, if you comprise only one stock, I mean you have only one standard deviation, and the point here is fixed, and it is no longer efficient. That means only one stock. That's what I think.
Okay, thank you. So I think is the right answer in this case. Okay, thank you. I want to show you a little bit about this content. So I will share my screen. So you can see in my screen the most important formula in this chapter is the variance of the portfolio formula. And so we have a classical framework for mean variance optimization. And this is the theory derived from Henry Markowitz, modern portfolio theory. So first of all, we have the covariance matrix of the stocks in our portfolio. And of course, we have the assumption that we fully distribute all our money into those stocks in our portfolio, which means the weight, the total weight will be equal 100%. And you can see we have we can calculate the mean and the variance of our portfolio with the weight vector is the row vector, just the row vector, not the column vector. So the mean of portfolio is the weight vector transpose. You just notice here, the comma here is a transpose. The weight vector, and you transpose the weight vector and you multiply with the mean matrix, of the portfolio stock. So you have the portfolio mean, portfolio return, and the variance. This formula is very important in this session. The portfolio variance equal the weight matrix transpose multiply the covariance matrix and multiply the weight matrix, okay? And with this formula, you can calculate the portfolio variance from the covariance matrix and the weight matrix. And I want you to remember the And sorry, I want you to remember the GMVP, the global minimum variance portfolio. That's that's the group 6 present in the first session. So in this case, we have the variance, the portfolio variance, and we just optimize this portfolio variance, and we can get the weight matrix that minimize the portfolio variance. So how we can do that? Is it not so difficult, because this belong to the calculus mathematics. That's maybe you just you already study in some courses. So we following Markowitz, we will minimize the portfolio variance here with the constraint. We have a constraint. Our constraint is the portfolio mean and the fully distribution our fund to on stock in our portfolio, which mean the weight matrix, transpose multiply the unit, the vector unit. Vector unit is just one, and this vector unit is on the row. So the weight matrix multiply the vector units and it's equal 0. That is our constraint. Or you can say the total weight of your portfolio is 100%. So this is the optimization problem, the optimization puzzle, and we just use the Lagrange multiplier to calculate the minimum value of this function, and we use the partial derivative with our variable here is the weight matrix, which means we choose the weight matrix to minimize our portfolio variance. And we can see here we use the partial derivative, and we suppose the partial derivative equals 0 to solve the solution of our optimization model. So we can have, when we just put the partial derivative equals 0, we can have the two linear system for lambda and y here. With the lambda is just the Lagrange multiplier, and we solve it, and we have the solution for the minimum variance portfolio here. It's very easy, yes. And we got this formula. When we want to find out the minimum variance portfolio, we just use the covariance matrix, and we inverse the covariance matrix. So notice this notation is invert, and the comma here is a transpose. So we inverse the covariance matrix and multiply it okay, because I don't know why. Sorry, I will do it again. So can you see my screen? Okay, I will do it again. So as you see, we just minimize this function with the Lagrange multiplier. That's our constraint. This is our constraint. And we have two constraints here about the portfolio mint, portfolio return, and about the fully invested in our portfolio, which means we deliver 100% our money. So we just optimize this function by using the derivative, the partial derivative, and we put the partial derivative equals 0. We solve this equation, and we have our parameter. And very easy, we just calculate the weight matrix. That's our variable in this case, and you can just look at carefully, but we just skip on the calculation here. It's quite easy. And we have finally we have the weight matrix equal the covariance matrix inverse multiply the vector unit. So vector unit is just the 1, 1, 1, 1, 1, 1, and vector unit here is a row. Is a row. Remember, just is a row, and divide by vector unit transpose multiply the covariance matrix inverse and multiply the vector unit. It's very simple. With this formula, you can find out the minimum variance portfolio. Okay. It's just very simple. If you don't use this way to find out the minimum variance portfolio, we have to use the solver in our Excel to find out the weight matrix of the minimum portfolio, of the minimum variance portfolio. Okay. So how this show how the Henry Markowitz theory figure out the minimum variance portfolio in our frontier, in our efficient frontier. Okay, you just see we have a this is our portfolio variance, and with two constraints here, we just take the partial derivative with the Lagrange multiplier multiply the constraint, and we have our solution. So the solution is easy to remember, and I hope you remember this solution in the portfolio optimization. We call it the traditional portfolio optimization because it's a very old. It's quite old from the Henry Markowitz theory. So it's quite old. Nowadays we deal with a lot of complicated optimization, and we have many ways to find out the weight matrix in case of many constraints that's combined in our model. So I will talk it later, maybe in the next session. Okay. Okay, back to group 6 presentation. You can continue your presentation.
So, good afternoon, teacher. Good afternoon, everyone. So, my name is Thảo-My, and I will continue to present the last part of today's session, which is estimating betas and the security market line. So, first, I will briefly remind you about the capital assets pricing model and two implication of the capital assets pricing model, which is the security market line and the capital market line. And then I will show you how to test the security market line and what are the problems in testing the capital assets pricing model. And lastly is the non-efficiency of the market portfolio. So first, as we have already know that the capital assets pricing model is one of the most widely used throughout the finance world for pricing the risky security and generating the expected return for assets given the risk of the assets, and it is used to determine a theoretically appropriate required rate of return of an asset to make decision about adding assets to a well-diversified portfolio. So in this box, we have the capital assets pricing model. We have the expected return on the security by taking, we can calculate the expected return on the security by taking the risk-free rate plus the beta of the security multiplied by the difference between the expected return on market and the risk-free rate. So we can differentiate between two kinds of implication of the capital assets pricing model. First, I will talk about the capital market line. It defines the individual optimal portfolios for investors who are interested in the mean and the variance of their optimal portfolio. So here we can see that here's the capital market line, but why line 1 isn't the capital market line, but it is line 2. So we will examine the point Q here, which is combining of the risk-free assets and the risky assets. So you can combining investment in riskless assets and risky assets, and you would achieve a point along the straight line from risk-free rate to Q. And here you can see at point 3, that means here is minus, that means that you borrowing in front of risk-free assets to invest in the risky assets. Although you can obtain any point on this line, but no point on this line is optimal. Why? Because here you can see that whatever the point you can obtain on line 1, you can obtain it, you can achieve it in the line 2, which is the capital market line, at the same standard deviation, but with the higher expected return. So line 2 here can be viewed as the efficient set of all assets, the both risky and the riskless assets. And talk about the capital market line, what about a security market line? So here we can see from this box, here you can see that the beta of the security, we already know that it measure the risk of the portfolio, and the expected return on a security should be positively related to its beta. Oh, and the security market line defines defines the risk-return relation for each individual asset. So so here you can, this box can be represented graphically by the upward sloping line in this graph. You can see that it begins at the risk-free rate, which is the intercept, and is right to this point, which is M, when the beta is 1, and the expected return on the security now is the expected return on the market. When the beta of the security is equal 1, you can see that the expected return will equal the risk-free rate, and as we have already know that only the expected return on the market have the beta of equal 1. So here, if the beta is equal 1, the expected return on a stock will equal the expected return on a stock will equal the expected return on a market. So for when the risk-free, in the case of risk-free assets exists, for the individual optimization, the capital assets pricing model state that each individual investor optimal portfolio falls on this line, which is here you can see that expected return of the portfolio equal the risk-free rate plus the standard deviation of the portfolio multiplied by the expected return of portfolio X minus the risk-free rate. And for the general equilibrium, so we assume that we all agree about a statistical assumption that the variance and covariance matrix that Locke and Menan had mentioned before. So, and if a risk-free asset exists, then an individual asset return are defined by the security market line, which is the expected return on an asset will equal the risk-free rate plus here is the beta of the assets multiply the expected return on the market minus the risk-free rate. And in the case of no risk-free assets exist, you can see that individual optimal portfolios will fall along the efficient frontier. So for here, as you can see that from this point to this point, from here to here, we can call it a feasible set, but no, all the investor only want their portfolio line on the curve from the minimum variance to this point. We can call it the efficient frontier. As we can see, if we achieve 0.1 here, you will have the lower expected return but higher standard deviation. While here from the point of minimum variance, we can achieve a higher expected return but lower standard deviation. So it is in the case of your portfolio comprised of two assets, and here is when your portfolio comprised of many security or many assets. So your portfolio can be in this area. However, as we discussed above, the investor only want their portfolio lines on this line, which is the efficient frontier, because as you can see, we have the higher expected return, but there's still the same standard deviation. And talk about a general equilibrium in case of no risk-free assets exist. We will have the individual assets return are defined by the security market line will be the expected return on the assets equal the expected return of the zero beta portfolio plus the beta multiply the expected return of the portfolio Y and minus the expected return of the zero beta portfolio. Third, I will move to testing the security market line. So first to testing the security market line, first we need to determine a candidate for the market portfolio. So in the next example that I show you, we will choose the S&P 500 as a candidate for the market portfolio. And then for each of the assets, we will determine the assets beta. And this is often called the first pass regression. And then we will regress the mean return of the assets on their respective beta. As you can see here, this is quite similar, but here we use the mean return in different terminology. So now I will show you the Excel file.
So what do you know about this this approach to test this SML? Do you know the name of the order that create this approach?
Sorry, I cannot hear you clearly.
So
Okay.
I just ask you about this approach. Do you know the name of the order? The name of the order that create this approach, create this method to test this SML or test the CAP-M theory.
Mm, the another name of testing this theory?
No, just this approach. Do you study about pharma market approach?
I'm sorry, what?
Do you study the pharma market approach in financial econometrics?
The farmer approach?
The pharma market.
I'm sorry, but I don't think that I have studied that because I don't remember about it.
Yes. So this approach is called the pharma market approach or pharma market methods. And it's used to test the CAP-M theory or test the pharma French two factors models. And all the models that's involved to the asset pricing, you can use this approach to test on the asset pricing model. There's two phases. The first is the progression to find out the beta of the security, and the second is just to request the return to the beta and other factors. So if you don't know exactly about this approach, just read the financial econometrics and the chapter about this approach. Okay.
Yeah. Yeah. So I'll continue with
Okay.
So here I have the price data for the Dow Jones Industrial Stock and the S&P 500. I have the price data from the July 2001 to July 2006. So first I will transform this price data to the returns, and here I will calculate from the 1st of August. So of here 1st of August divided by the 3rd of July. And similar to the rest of the month, we have like this, and we simply applied for the rest of for the remaining stock. So in here, I will calculate the average return by the function average. Sorry. And simply applied for the rest. So, and now I will as I have shown you before, that the first pass regression we need to calculate the betas, and here when we calculate beta, I will use the function slope. So and I will fix, and the beta of the market, as I have mentioned before, that will always equal 1. Here. And here we'll calculate alpha, which is the intercept. I will use the intercept function. And I will have the alpha of S&P 500 index equals 0. And simply apply for the rest of the stock. And here we calculate the R square by the function R squared, similar to calculate the slope and intercept. So yeah, and so from the beta, the alpha, and the R square will give you the result of the first past regression based on here, as I have shown you before. And yeah, and then I will calculate the average alpha. Here's the average of data. And similarly, I have the average of the R square. So because each of stock we have a different R square, so I will use the function SUMIF to let's see that if the R square is larger than 0, and we will sum all of the R square by the function SUMIF, and select the R square from the AA stock to the AF stock, and here is larger X here. You will have the sum, and we will count that how many stock that have the R square which is larger than 0.2. No, sorry. Teacher, can I ask a question, teacher?
Okay.
I don't know why, but my stock is still 30, but I have seen that there is some that is smaller than 0.2. For example, that is here.
That's where
I counted is 30, which is
30.
here is the total of 30 stock, but there's some R square that is lower than 0.2.
Lower than 0. 30 is the total of stuff, and
Yeah.
you want to take the answer larger than 0.2.
Yes.
So I think that the count here is the count has some problem. You just click on the count it, okay, and let's see here. Let's be 48 or 0. Why you use the n with text? So it's I'm confused here. Yeah, the function that I want to use greater text. You just click the count it to see how the function work. You just click on the count it. Okay.
Like this.
No, you put your mouse on the count it, and it's have an underline in the count it. You click it to show how the function work with the components.
Here is countif is range in criteria.
Yes, range criteria, and our criteria is 0.2. We have a total 30 steps, and on our stop larger than 0. The answer of on our stop
I'm sorry, I cannot hear you clearly. Is 0, 0.2.
0 greater and text 0.2 the B84.
The B84. Oh no, fine. Yeah.
And text. Two and 0 text just 0.
0.
Yes. Yes. Okay.
Is still 30.
Still 30. Okay, I think that this is not important. I will figure out this formula, and I will tell you in the next session. And it's just about you calculate the total R square for all the regression, just divide by on the number of our regression with some conditions. With some condition we attach to it, but there is so, you can see here we have the regression R square. That number is more important with the because when we do the second steps, second regression, so we have the R square from the regression, and we can take on the regression to the representing R square or presenting graph. Okay, just
Yeah. So we have we move to the second pass regression. Let me pass the. Oh. Oh, and I will use the function transpose to the data from here. First return data number. Here. So now we will examine the hypothesis by regressing the mean return on the betas. Here's the intercept. And we calculate, similarly we calculate the slope. Here and the R square. And the beta. So here you can see that from here you can write it at the second pass regression. You can see that here the expected return will equal the intercept is 0.0036 minus the 0.002 multiplied by the betas. Okay, and we calculated T intercept. Similar. Jeez. So now I will try to graph the security market line based on the beta of the assets and the expected return I use it at the capital assets pricing model return. So here you have the beta. This. Sorry. Here equal transpose. Yeah. Here it can return. I will use 0 point plus with this one multiply with beta. and then I will fix it. To the rest, and I will have here. So now the graph. Oh. Try to select data. Now the x value here is beta. And the e value is this one. Teacher, I don't know why, but it's downward sloping.
Downward sloping. So remember that's the theory about XML security multiply. It's a top-end theory, and the line will upward slope. And so in this case, we have a very bad second class regression, which is square very low. You can show us the statistics of our second class regression.
Here.
Okay, the R-square is just 2%, over 2%, and the slope is negative. So the slope is negative, which means the line will downward slope.
Yeah.
So it's not right. It's not appropriate to our top-end theory in this case, this situation. But you have to know that why we encounter this problem in this situation, because so the author also explained for us why we have a problem with this calculation, the SML calculation here, because the first reason for this problem that when you calculate the beta from the first regression, that's not enough the data to create, to calibrate the exact, the precise beta of those stocks. So that's the first reason for our problem here. The second reason that you can see here is the market portfolio. So we use the S&P 500 represented on the market portfolio, but this is not, sometimes it's not enough to represent the market portfolio. The market portfolio in top-end theory is still mysterious, just because we don't know how to build exactly the market portfolio on the stock, on the security in the market. This is not the market portfolio. That's all the risky assets in the financial market. That is the market portfolio, all the risky assets in the financial market. So in here, we just use the S&P 500 for the market portfolio, and it's not correct. It's not precise to use the S&P 500 index, and we don't have the precise security multiplier here in the second pass regression. Okay, that's the reason. That's the reason why we cannot for the proper SML. The proper SML will be upward slope, and all the securities will lie on the will inside this line, will on this line. But in this case is maybe we have the wrong calculation for the two problem, for two reasons I just told you.
Yeah. So I will move on to the next part.
Okay.
Yeah. So sorry. Here we will as the teacher have mentioned that we have some problem with the capital assets pricing model. And so now I will create a mysterious portfolio, which is this portfolio is efficient with respect to the Dow Jones 30 stock, which is 30 stock right here. And similar, I will calculate the log return. Here's the log return and the average return. So to have the to calculate a mysterious portfolio, we need to find an efficient portfolio, and then we will use the function the function matrix multiplier to find out the mysterious portfolio, which is efficient with respect to the Dow Jones 30 stock. And right here S&P. And the beta. Fix it. Yeah, also the intercept. And the R square. And here now, as Lopez mentioned above, we will calculate the variance and covariance matrix. And here I will use the function var for medians from. Sorry, I will choose one of it. use function Mean-Variance-Covariance. Yes. And here we have the variance and covariance matrix. And to calculate the mysterious portfolio, you need to finding an efficient portfolio based on this function. Use the M multiply matrix and the inverse. And we take the phi and co-phi here, which is we have already calculated both transpose the from the average return and minus the constant C and divided by the sum of inverse and code. And similarly transpose from the average return and minus the constant. Sorry. C494. Cool. Mute Mean-Variance transpose minus divided by the sum of M Mean-Variance transpose of minus or so now we have finding the inefficient portfolio, and now we will use this to calculate the mysterious portfolio. And here we'll use the function in by matrix of the return and then multiply with right here. To equal 0.1. Similarly to the rest of the day in the year, you will have the mysterious portfolio like this. Now we calculate the average return. Mysterious portfolio. And here we calculate the beta. Use the function slope of this one. And we will fix the mysterious portfolio. So at the beginning, we have the S&P 500 index here, but now we will replace it by the mysterious portfolio, and we have another beta. Similarly, we will calculate the intercept. And we'll fix it. And here is the R square. And now I will, this is the first step, that is the first past regression, and now I will use the second pass regression by regressing the average returns on the betas. I will use the function intercept C4 to and similarly is the slope. And the R square. But here you can see that the R square equal 1. So that means that here the resulted regression has an intercept of 0.03 and a slope of 0.0425, and it has the R square of 100%, which is the goodness of fit is high. So that is why we replace the S&P 500 index by the mysterious portfolio by we calculate an efficient portfolio by finding an efficient portfolio. And here we calculate like the beginning, we have the average alpha.
Okay, you can stop here because this is not important.
Yeah.
For us. So any conclusion about this chapter?
So as here, so as teachers mentioned above, that we have some problems in testing the capital assets pricing model, which is one reason is that the capital assets pricing model does not hold, and because for the first reason is that the market short sales of the assets are restricted, or perhaps we don't have the same expectation of the assets return, the variance, and the covariance. And the capital assets pricing model holds only for the portfolios and not for the single asset. And perhaps our asset isn't large enough or the market portfolio isn't efficient. As here in the example, our example that is the S&P 500 index that it isn't efficient. And the capital asset pricing model holds only if the market returns are positive. So the non-efficiency of the market portfolio, that the fact that our S&P 500 portfolio is not efficient related to the set of we choose 30 assets which we have chosen, and as Manan has presentation, we have the proportion 3 in chapter 9 state that if we had chosen to request our assets return on a portfolio that is efficient, that is our mysterious portfolio that I have present, we would get an R square of 100%. And if we get an R square of 100%, then the portfolio we request the assets return is efficient with respect to the set of the assets. And that is the end of our presentation. Okay.
Okay, thank you. So with due respect, I think some ideas the author just show us in this chapter is not appropriate, is not relevant at all. For example, the author say the market portfolio isn't efficient, perhaps, but I think the CAPM framework is a proof in which the market portfolio is really efficient. And but the market portfolio, you don't know what exactly market portfolio. What do you have in the market portfolio? All the risky assets in the financial market. So nobody can create the market portfolio, the real market portfolio in the reality. So that is the problem. That's when you study about the CAPM, and you can see we have some assumptions, and the market portfolio is just still mysterious for us because we don't know exactly how many assets, how many risky assets we have in this portfolio, market portfolio. Okay. So thank you for group 6, and I think you present a lot of knowledge for us for our class in the chapter 8, chapter 10 and 11, and we study a lot of things from the group 6. So I will give you 9 mark for your presentation, and thank you. Ok, thì chắc là thầy sẽ cover lại một tí xíu, thì nói bằng tiếng Việt đi để cho một số bạn có thể rõ cái ý trong cái chương 11 này. Thì ra trong cái quyển sách của mình á, nó có 2 cái mô hình, 2 cái nội dung á, mà phải nói là tác giả hơi là cổ điển, tức là sử dụng Excel, trong khi là bây giờ các phần mềm nó có hỗ trợ cái phần code để chúng ta check 2 cái dạng nghiên cứu này. Một á, là cái dạng nghiên cứu mà để test cái đường security market line này, test cái mô hình CAPM này, và cái thứ hai nữa là cái event study. Thì event study các bạn không có học, nhưng mà event study ở đây tác giả cũng làm bằng Excel, và nó khi mà các bạn làm Excel vậy nó hơi là chậm, với lại là các bạn chỉ xử lý ở một cái số lượng securities nó ít thôi, chứ các bạn xử lý khoảng chừng 1.000 trên 1.000 đến 10.000 cái cổ phiếu thì các bạn sẽ thấy các bạn không thể nào làm trên Excel được với cái dữ liệu đó. Ví dụ như trong cái ví dụ này, trong cái tình huống này của chúng ta là chúng ta kiểm tra cái mô hình cấp em, mà cái phương pháp mà tác giả kiểm tra ở đây á, cái hồi quy 2 bước ở đây á, tác giả thực ra ông tác giả quyển sách này ổng cũng không có tôn trọng cái người mà đầu tiên đưa ra cái phương pháp này. Cái phương pháp này gọi là phương pháp Farmer-Macbeth, và cái phương pháp này nó rất là phổ biến ở trong cái bài nghiên cứu của Farmer-Macbeth năm 1973 thì đã đưa ra cái phương pháp này để test cái lý thuyết về cấp em. Sau này tất cả các cái mô hình định giá tài sản khác thì đều có thể sử dụng cái cách tiếp cận này, cái phương pháp của Farmer-Macbeth để test. Thì cái phương pháp của Farmer-Macbeth thầy có để một cái link cho các bạn xem cái bài gốc của Farmer-Macbeth ở đây ha. Và trong cái sách kinh tế lượng, nếu các bạn học môn kinh tế lượng rồi á, thì các bạn cũng không biết là nó không có trong nội dung, nhưng mà các bạn đọc thì các bạn cũng sẽ thấy nó cũng có giới thiệu cái phương pháp này. Tại vì phương pháp này nó cũng khá là kinh điển, và chúng ta cũng nếu mà ai học về các mô hình định giá asset pricing, định giá tài sản, thì đều biết cái phương pháp tiếp cận này. Thì phương pháp tiếp cận này như nãy giờ nhóm trình bày, nó cũng là cái nguyên tắc cũng là 2 bước. Thì đối với mô hình cấp em, chúng ta gọi mô hình cấp em là mô hình có một nhân tố thôi, một nhân tố, và nhân tố chúng ta ở đây chính là beta. Còn nếu mà chúng ta muốn test cái mô hình Farmer-Macbeth 3 nhân tố thì chúng cũng thực hiện giống như vậy, cũng giống như vậy. Cái first regression của chúng ta, cái first pass regression ở đây tác giả trình bày đó là chúng ta đi hồi quy để chúng ta tính cái beta, đi hồi quy để chúng ta tính cái beta, chúng ta ước lượng để estimate cái beta. Và sau đó thì chúng ta qua cái hồi quy thứ hai hồi quy thứ hai thì cái beta bây giờ là từng cái beta chúng ta sẽ dùng cái beta để chúng ta giải thích cái tỷ suất sinh lợi của cổ phiếu. Thì trong cái mô hình cấp em này nó chỉ có một yếu tố thôi là beta, và mô hình cấp em nó chính là thể hiện trên biểu đồ, nó chính là cái đường SML cái return nó sẽ được giải thích bởi cái beta của cái rủi ro thị trường, cái rủi ro hệ thống của cái cổ phiếu của chứng khoán đó. Thì nếu như chúng ta không muốn test mô hình cấp em mà chúng ta muốn test mô hình 3 nhân tố thì chúng ta sẽ cộng thêm 2 nhân tố còn lại thôi. Thì cái bước thứ nhất thì nó cũng giống vậy. Bước thứ hai thì các bạn hồi quy thì các bạn dùng beta nè, rồi các bạn dùng biến quy mô, và các bạn dùng biến giá trị sổ sách trên giá trị thị trường của cổ phần. Thì đó, 2 cái nhân tố còn lại trong 3 nhân tố của các em. Trong 3 nhân tố của các em, nhân tố thứ nhất là beta rồi, nhân tố thứ hai tính là size, tức là quy mô của công ty. Thường nó lấy log NPE của size và lấy log NPE của giá trị sổ sách chia giá trị thị trường, và chúng ta sẽ test được cái mô hình 3 nhân tố đó. Thì nó cũng y chang như là test cái mô hình cấp em, nhưng mà chúng ta cái bước hồi quy thứ hai chúng ta thêm 2 nhân tố nữa thôi. Thì cách tiếp cận đó chúng ta gọi là cái phương pháp của Farmer-Macbeth năm 1973. Và như thầy nói cái này hiện ra các cái chương trình phân tích dữ liệu giờ như là Stata, eView hay là Error thì nó đều có code sẵn, hoặc có các cái package, các cái gói sẵn để nó phân tích về test cái mô hình định giá tài sản này, sử dụng cái phương pháp của Farmer-Macbeth. Tại vì sao vậy các bạn? Tại vì nếu mà các bạn làm trên Excel gì nó sẽ tốn rất là nó sẽ rất là dài. Giả sử như, và thường cái beta mà bạn ước lượng trong cái hồi quy đầu tiên để ước lượng cái beta thì các bạn vẫn dùng cái mô hình model market như nãy thầy nói các bạn, tức là R của cổ phiếu nó sẽ bằng alpha cộng cho beta nhân với lại R của thị trường, tỷ suất sinh lợi của thị trường đó. Thì các bạn chỉ cần cái tỷ suất sinh lợi cổ phiếu và tỷ suất sinh lợi thị trường thì bạn sẽ ước lượng ra được cái beta qua một cái hồi quy đơn giản thôi. Cái đó là tuân theo cái mô hình model market. Khi mà ước lượng beta vậy thường thì người ta nói là các bạn phải lấy cái dữ liệu là thường là dữ liệu tháng, và lấy khoảng chừng từ 3 cho đến 5 năm, 3 đến 5 năm đó, để chúng ta ước lượng cái beta nó chính xác. Thì ở đây chúng ta thấy là dữ liệu này thì không biết gì, đúng là dữ liệu này vẫn là tỷ suất sinh lợi tháng, nhưng mà cái thời gian nó không có nhiều. Thời gian ở đây thì đây là chính là một cái problem hồi nãy thầy mới nói. Cái problem đầu tiên là cái ước lượng beta ở đây, cái hồi quy thứ nhất ước lượng beta ở đây nó chưa đủ dữ liệu để chúng ta có thể chắc chắn là cái beta này nó chính xác hay chưa. Và cái thứ hai là cái chỉ số S&P nó chưa đủ để đại diện cho cái danh mục thị trường, chưa đủ đại diện cái danh mục thị trường. Do vậy thì cái kết quả trong cái việc test cái mô hình cấp M ở đây nó ra gần như là không chính xác, và không phải như vậy mà chúng ta nói là mô hình cấp M nó sai. Và tác giả ở đây, tác giả cũng cái framework, cái mô hình cấp M, cái framework nó hoàn toàn đúng. Và khi mà tác giả không sử dụng cái S&P 500 mà tác giả sử dụng một cái danh mục bí ẩn. Và danh mục bí ẩn này là gì? Danh mục bí ẩn này là một cái danh mục hiệu quả được tạo từ các cái cổ phiếu mà chúng ta tính ở đây, kiểu như là những cái cổ phiếu mà chúng ta tính đây, chúng ta không dùng S&P 500 mà chúng ta dùng các cổ phiếu ở đây để chúng ta thành lập, chúng ta tạo ra cái danh mục hiệu quả. Danh mục hiệu quả thì cái này nó sẽ nằm ở trong cái nội dung của chương sau, nhưng mà hồi nãy các bạn cũng đã trình bày luôn rồi, là cái công thức, cái hàm để tạo ra cái danh mục hiệu quả từ các cái chứng khoán chúng ta có ở đây. Và nó cho thấy một điều, khi mà chúng ta tạo ra đúng cái danh mục hiệu quả đó, thì khi mà chúng ta hồi quy cái bước thứ hai á, thì R bình nó sẽ bằng 1. Tức là sao? Tức là tất cả những cái điểm, những cái cổ phiếu á, nó đều nằm trên cái đường SML hết, đều nằm trên đường SML, nó đúng với cái framework, cái framework cấp M của chúng ta. Rồi, chính vì vậy thì chúng ta thấy rõ là sử dụng cái chỉ số S&P 500 nó không phù hợp, có thể nó không phù hợp tại vì nó không đại diện cho cái danh mục thị trường nữa đây. Còn một số các giả thiết mà tác giả đưa ra thì giống như là danh mục thị trường thì nó không hiệu quả thì nó không đúng. Danh mục thị trường thì chắc chắn nó hiệu quả, chủ yếu là các bạn phải biết là danh mục thị trường nó là cái gì. Các bạn phải biết cái danh mục thị trường là cái gì thì các bạn mới chắc chắn được ha. Ok, vậy thì buổi sau chúng ta sẽ đi tiếp để chúng ta xem coi thiết lập cái danh mục hiệu quả như thế nào nha các bạn. Ok, rồi vậy thì hôm nay chúng ta dừng lại đây ha các bạn. Buổi sau thì chúng ta vẫn đúng theo cái lịch là sáng thứ Năm nha các bạn. Ok, rồi chào các bạn ha. Nhờ lớp trưởng ghi nhận lại điểm của nhóm giúp thầy nha.
Thầy ơi, thầy cho em xin cái lần trước thầy có nói là trên thầy có đăng lên LMS cái bài mẫu của cái bài tiểu luận đó thầy, em vẫn chưa thấy á thầy.
Ok, để thầy để lên một số cái bài để thầy chọn ở mấy cái lớp trước, mấy bài thì thầy up lên LMS cho các bạn tham khảo ha.
Em cảm ơn thầy.
Ok. Nhưng mà nhớ các bạn làm bài của các bạn phải làm bằng tiếng Anh đó nha, chứ không có viết tiếng Việt nha. Ok, vậy rồi. Ok, vậy chúng ta dừng tại đây các bạn. Hẹn các bạn tại buổi học sau. Cảm ơn các bạn.